Hello everyone, we are going to go ahead and get started. Welcome to today's webinar, State and Local Tax Opportunities and Risks for the Restaurant Industry, sponsored by GBQ Partners, LLC. Today's moderator is GBQ's Tax and Business Advisory Services Director, Kaz Unilin. Also, today's presenters are GBQ's State and Local Tax Services Directors, Matt Stamp and Jeff Monsman. Now I'll turn the call over to Kaz Unilin to start today's presentation.
Great. Thank you, Kyrie, and thanks everyone for joining us here this morning. Appreciate your time. As Kyrie mentioned, my name is Kaz Unilin. I'm Tax Director here at GBQ and co-lead our restaurant practice. And joined by a couple of my colleagues, Matt Stamp, who heads up our entire state and local tax practice of about, 8 or 10 people. Matt's going to talk a little bit today about some credits and incentives and sales tax. So we'll hear from Matt here shortly. And finally, my other colleague here, Jeff Monsman, he's a director on our state and local group. And Jeff specializes and going to talk about property taxes, sales tax, and other indirect taxes. So got a great list of speakers here today. So some timely topics and relevant ones. So we'll just kind of get started here. This is just kind of our standard disclaimer here on the presentation. But today's agenda, I'm going to talk about some employment tax credit updates, just really touch on the credits themselves at a very high level, but just give some updates on some recent notices that were released by the IRS that's timely and important for the restaurant industry. And then, as I mentioned, Matt, he's going to cover some credits and incentive opportunities that we see in the restaurant space, just to give some insights on that. And then also, I think both Matt and Jeff are going to talk a little bit about sales tax. And then finally, I think Jeff's going to wrap things up on property taxes. So we have a pretty full agenda today and a lot of good information. So we'll just jump into it and get started now. Kyrie, I think, mentioned a little bit of housekeeping about CPE. Our first activity code word is opportunities. So I think we want to just get that out of the way here. If you all would please click on opportunities to get you in the CPE queue here so that you get your verification for today's webinar. All right, great, thanks, Kyrie. So as I mentioned, I'm going to talk a little bit about just some updates in the employment tax front. I'm not going to spend a bunch of time talking about the credits themselves. The first one that I want to talk about is the employee retention credit. Hopefully everybody on this call knows about this credit, has some understanding about the credit, and has looked at the credit. Most all of our restaurant clients have qualified for this credit in one form or another, meeting some of the basic eligibility requirements. And I just listed this out here, kind of what it is. It's a refundable payroll tax credit. The Consolidated Appropriations Act, signed in December of 2020, retroactively changed this credit and opened it up to, basically all taxpayers, even if you got a PPP loan. And then the eligibility requirements here, just, the significant decline in gross receipts or the partial or full governmental shutdown or suspension. And so again, from a restaurant standpoint, a lot of our clients can get there on the decline in gross receipts. But the big one that really everybody can get there one way or another has to do with the full or partial governmental shutdown. So again, I'm not getting into details on this one, but just want to, throw that out there just as a general summary, and hopefully everybody's taken some time to look at this credit and see if there's an opportunity there. Next slide, please, Kyrie. So some important updates related specifically to this credit. As I mentioned, to kick things off, there was an IRS notice 2021-49 that was just released still this month, August 4th, that gave some clarification on a couple points related to this credit and calculating it. So the first one to note has to do with the determination of FTEs. So for this one, it's the number of full-time equivalents that determines, your qualification for these qualified wages. And so in computing the number of FTEs, you're not required to include full-time equivalents in the calculation. Instead, you look at the number of employees that have had an average of 30 hours per week or 130 hours in the month of services that would qualify as one FTE for this calculation. And the FTE count in looking at eligibility for this credit is very critical. I didn't get into this with that introductory slide, but if you have 100 or less FTEs for 2020, then all of your wages qualify for this. So that's important. And then for 2021, it's 500 or less FTEs qualify all of your wages for this credit. So again, that was something that we were waiting on guidance of. I think, we had thought that was the case when we have been doing these studies and looking at this for clients. So that just kind of confirmed things. The other big one that was really, I guess squishy was the treatment of tips. So we really weren't sure how tips were treated because theoretically those aren't wages you're paying. The customer's paying that, and it's included as compensation for the employee or the server. And so it was a little bit ambiguous. And so this notice clarified that the tips earned by employees that are part of the wage calculation for this credit. So that's that's a big deal. So, and those same wages are also qualifying you for the FICA tip credit. So on that, you can double dip, and it doesn't disqualify you from getting the FICA tip credit or reduce the FICA tip credit. So again, this one is definitely restaurant specific related to the treatment of tips. So it was good to get that clarification. The other big one that was really nebulous in all of this was timing of the disallowance on the wage deduction. And so, essentially, if you get $100,000, let's say, in these credits, well, from a federal income tax standpoint, you have to add 100,000 of wages. So from that standpoint, it was kind of unclear as to the timing of that, because a lot of these, that change was retroactive. So a lot of these refund claims that might have been for 2020 wages, weren't filed until 2021. However, the rule is crystal clear that if you get these credits from wages paid in 2020, that adjustment has to be in 2021 or in 2020, and the same goes for 2021. So we've kind of been holding off on filing some of our clients' returns, waiting to get this calculated to make that adjustment in 2020, and that was absolutely the right call based on this release. So it confirmed that. Then the final thing here has to do with qualified wages for related individuals. And essentially, what this was, it had to do with attribution and ownership for wages related to spouses and, married couples, that those wages will not be qualified wages eligible for the employee retention credit. So that notice came out and specified that as part of that release. The one other thing I guess I was going to mention that is that's out there is that even though the employee retention credit was extended through the end of 2021, there's been recently released draft of the infrastructure bill, and one of the considerations in there will be to end the employee retention credit after the third quarter of 2021. So again, that's something we're keeping our eye on. As of right now, it's through the end of the year. But if this infrastructure bill gets passed as is, it's going to actually eliminate the fourth quarter and only be good through September 30th of 2021. So just something to keep an eye on or think about as you're planning and qualifying for that credit. Next slide, please, Kyrie. So just a couple of points here I wanted to mention on the employee retention credit. What we're seeing within our restaurant clients, aggregation rules, very complicated. So a lot of our clients have different entities, maybe with different ownership, and you really need to look at those rules to see if those entities are standalone or they're part of a bigger group. And really the importance is that it comes down to, a lot of times, is the FTE count. I kind of mentioned earlier, whether you're under that 100 FTE threshold for 2020 or that 500 FTE threshold for 2021. Those aggregation rules, are very meaningful in whether or not that there's some credits out there for you. So and they're complicated. So that's something that should absolutely be looked at very closely before you, write off this opportunity. The other big one is the governmental, full or partial shutdown and just substantiating that. So I think, every restaurant was impacted differently here, but, as an example, in the QSR space, dining rooms were limited or shut down, but drive-through was still open. So still doing very significant business through the drive-through. And so this governmental or full or partial shutdown needs to be substantiated to really show that there was a more than nominal impact to your business in order to qualify for these credits. Again, it can be very nuanced based on your situation. So you want to absolutely make sure that you got it documented and understand those rules, because the IRS, as part of the employee retention credit, expanded the audit period from 3 years to 5 years. So to me, that signaled that they're going to be looking at these down the road. The other big one is just coordinating with PPP forgiveness to, maximize this credit in terms of, using payroll for PPP forgiveness versus other expenses, and what quarter and when the PPP was used for wages, because you can't double dip that for this credit. So I think that that's another one to really keep an eye on. The other one is just in general, I think I mentioned this out of the gate, we've got just a lot of people who've just kind of written this one off just based on the number of employees they've got, or how they're organized or structured, or maybe how they did during the year. We've had, instances where somebody thought they didn't qualify, wind up finding out, they've got a 7-figure refund coming. So there's absolutely real value here and something to look at and look hard at. Next slide, please, Kyrie. How can we help? We've been doing a ton of this work, seen a lot of different situations. So we can determine and document eligibility. We can prepare the calculations themselves. We can prepare, review the amended payroll tax forms that are filed to get this refundable credit. I mentioned, maximizing the credit along with, the PPP wages that you may have used related to it. And then finally, just general consulting. Again, seen many different situations, and there could be a lot to look at there in some circumstances. Next slide, please. Work opportunity tax credit. I just want to take a few minutes to touch on this real quick. This is nothing new, hopefully, to anybody on this call, but this is just another one where we're still seeing folks that aren't taking advantage of the work opportunity tax credit. And so this is really more of a couple slides here to raise the awareness. This is just a little bit of the history about the credit and what it is, but I'm not going to go into it. Next slide, please, Kyrie. I think the important thing here is, are you a good fit for WOTC? If you're in the restaurant industry, yes, you are. You can see here we kind of listed out where we typically see eligibility for this credit. Restaurants are at the top of the list. Absolutely should be something to look at. Then the employee base, our restaurant clients check all these boxes in terms of the turnover, who you're hiring, how many people that you're hiring. I think this credit was built for folks in the restaurant industry. And then, finally, that kind of next box there is tax position. If you're gonna have a current or future tax liability, it's a 20-year carry forward, with where rates are going. And, I think there's a lot of folks hopefully on the rebound here that are starting to see some light at the end of the tunnel, that those credits absolutely be valuable down the road. Next slide, please. Top 5 reasons companies aren't claiming this. We don't hire people to qualify. Again, if you're a restaurant, you do. We don't want to invade our employees' privacy. We help our clients with this credit. It's very easy to administer. It really doesn't, it's not invasive at all. Can't use the tax credit. Again, I'm pretty sure that wouldn't be a problem for most folks at some point in time. Will take forever to receive the benefit. Again, Nevada might be notoriously late, but all the other states are pretty easy to work with in getting this credit. We don't want to deal with the paperwork. Again, with just online applications or integrating it with your hiring and onboarding process, it's very, very easy to implement and see if you can get folks qualified for it. Next slide, please. Then finally, how can we help? We can help size up opportunities for the WOTC. We can help implement it, screen candidates. We can do the calculation and submission and certify it, and essentially help our clients get that credit. So I think that's it for this one, Kyrie. So at this point, I'm going to turn things over to my partner, Matt Stamp. He's going to dive into credit and incentive opportunities, and let Matt take it from here. Thanks, Matt.
Thanks, Kaz. So again, Matt Stamp, Director of State and Local Tax, talking about a little bit about other credit incentive opportunities that are out there. I think one of the #1 questions that we always get is what am I missing? So from owners, what's out there? What are we missing? Can you take a look, see what's going on? So, everybody should know that all 50 states rely on incentives to entice business investment. So what do those investments look like? Usually they come in form of tax credits or grants, low interest loans, training assistance, property tax abatements. And, those are the things where they come, but the question is, how do we get them, right? And so incentives are really event driven. So there's triggers that happen, right? So, you got to have certain hiring of a number of individuals or projected growth in your workforce. You're going to have significant investment, machinery, equipment, some type of investment in your location. You're either entering new markets or significant real estate transactions. The one thing you should know, though, is that a lot of states, though, are focused on certain targeted industries, and those include, manufacturing, high tech, software, different industries than restaurants, and so the states really don't care for retail as far as enticing or investment opportunities. So why am I telling restaurants that? And the reality is that restaurants need to look at alternative places to look for help or assistance in what they're trying to do. So, during COVID, we did see a lot of grant opportunities, specifically money that was set aside for restaurants. There's a restaurant revitalization programs, different things. And ultimately, a lot of those monies are gone now. So the issue is, as we continue to move and get away from the pandemic and continue to see more investment from restaurants, more growth, what are we looking at from incentive opportunities? And what we kind of talk to our clients about, it's not just, you got to look for the grants and see if there's any kind of local grants or anything that are available. You always want to take out, look at the loans and what kind of interest you're paying. Is there any low interest opportunities? There's always significant things for minority or women-owned businesses, SBA loans and those types. And then also talk about local opportunities. So you need to look at grants, look at any permits or fee abatements, waivers. If you've got utility issues, talk to the utilities, see if there's any opportunities. Most people don't know that the utilities also have some economic development monies that are available, depending on the project, depending on what things are going on. And then, a big one is training and employer resources. So, you need to find out if there's anything local of being able to attract or obtain talent. And then once you get the talent, to be able to help train them and looking for different resources. So we always recommend that you build a relationship with your local government and your local economic development professional, even if it's just to get to know them, so that if there are future programs and things that they're looking at, that they think of you, that there's opportunities for you. Like I said, very location specific. So we kind of help our clients look at wherever locations they're at and see if there's any opportunities for them. So next slide, please. So the second challenge word is challenges. Keep that for your poll, please. Now I'm going to switch it over to Jeff Monsman to kick off the sales tax update, and I will be back towards the end of his sales tax portion with a little bit more on some other opportunities.
Yep. Thanks, Matt, and thanks for showing us up with the jacket today. Me and Kaz didn't quite get the memo on that one. That's okay. So we're going to kind of go through just an update on some of the stuff we've been seeing with sales tax. A lot of generally. Anytime we're kind of talking about sales tax in the past couple of years, that the focus always runs to that economic piece. And while it may not necessarily affect restaurants directly in some new collection requirements, things of that nature. There are some items and something from the sales tax being charged on purchases that could come into play. So just a quick update, we finally have hit that point on the economic nexus side, where every single state now has some type of economic nexus law in place. So Florida, Missouri were the last two stragglers. Florida is officially effective, as of July 1st on that economic nexus side, and Missouri is actually going to give their sellers and their remote sellers a little bit of run up. So effective January 1st of 23, Missouri will be fully on board. But a lot of taxpayers have kind of taken that opportunity to get registered early and really kind of just get it in place and go that way. Certainly don't have to, but if you have reached the nexus threshold in those other states, then you certainly can. Our trends really are still remain the same. So, most of these states are trending towards that prospective enforcement from their as of dates. Now, what we have been seeing, and actually had this issue pop up just recently, is when people are completing registrations, even if they're moving into a new state, they're getting a cursory phone call, email, something in the mail asking what they were doing prior to that date in the state. So, if it was sales activity or if it was something along those lines, really kind of making sure and nailing down that these taxpayers were, kind of establishing nexus the day that they were, and could invite, maybe a short look back period audit. We'll talk about that here in another slide or two, but know that, there are those things that are still possible. The transaction threshold is moving away, kind of became a little onerous, and some states have actually they've adjusted those thresholds, and they've adjusted and kind of removed the transaction thresholds, because what's happening is people were establishing nexus through microtransactions. So maybe you only had $5,000 or $10,000 worth of sales, but they hit that 200 number into a state, and so really wasn't getting the taxpayers into compliance that they were looking for, and maybe kind of putting a burden on some of the smaller ones. So the main focus kind of across the board has certainly been on the dollar threshold, but there are still some of the transaction ones. The one question that we always get when we kind of start talking about these trends is, does economic nexus really replace the physical presence test? And in a word, that answer is no. So if you're physically present in the state, that's always going to give you that nexus in a particular state. So if you open a new storefront, you open a new restaurant in a state, and you're kind of ramping up, know that day one, if you're physically there, you're availing yourself to that business, that physical presence standard still exists. The one other thing, as all of these economic nexus laws come into play, that we really want to hit on, and it pertains to restaurants, is that paying attention to invoices from out-of-state vendors, really to confirm that sales tax is properly being charged. And what I mean by that is a couple things. First and foremost is there are some exemptions that are available specifically to restaurants that is on the restaurant to claim, to give an exemption certificate to your vendor and make sure that if it was exempt and they're an out-of-state vendor, it's on you to tell them that it's an exempt transaction, not the other way around, if it would be otherwise taxable. And then the other item is making sure that the proper tax rate is being charged. If you have an out-of-state vendor, they may just take the shortcut and start charging you sales tax based on where they're coming from, their home state items, which in the future could cause issues as far as audit, or just kind of proving out that hey, I'm paying 8% sales tax. That's a cross-border rate. My home rate is 6 3/4. You can be costing yourself money in those situations. So this economic nexus piece, while restaurants are necessarily selling over state borders, really does have that effect in supplies and making sure those right rates are being charged. So it's important to know that every state's on board, and most vendors and most larger vendors are going to be charging tax kind of across the board here. If not now, certainly within a couple of years. Next slide, please, Kyrie. So, what we have seen on some of these state enforcements are your general nexus questionnaires and information letters that we've been seeing for years. The volume of these items are certainly popping up, though, however, because it's a good touch point for these states. Sending out administrative notices for unregistered taxpayers to say, hey, we've got this new filing requirement. Are you on board? Maybe accounts aren't matching up. So if you have a franchise tax account, but you don't have a sales tax account, that could generate one of these general letters, a nexus questionnaire, something along those lines. You know, the one question, and this predates all the economic nexus pieces. When you get a nexus questionnaire, you know, what do you do with it? Do you respond? Do you not respond? And in that situation, our advice really is to, you know, certainly respond, but don't be kind of completely forthcoming with every possible factoid that you could ever have. Answer everything honestly and truthfully, but kind of, you know, short and sweet and to the point is certainly, you know, the best way to look at it. Desk audits are rising in popularity as well too. People were going home from, you know, COVID, and they realized that, hey, we don't have to do a lot of traveling for a lot of these items. So what's happening are states are auditing, you know, states that you didn't see a whole lot of audits recently are starting to conduct these desk audits where they're kind of a, you know, a fast lane audit, really high level, and they're kind of asking for information, and it's a pretty quick process. We've seen states, you know, like Maine, South Dakota, things of that nature. Kind of some of these outlying states have certainly started opening up these audits. And again, you know, the look back period for this nexus, not terribly pertinent to restaurants, but just know that it is usually prospective, and you're kind of looking back. For the most part, it's either current or prior year, or kind of that trailing 12 months. So again, just always monitoring your sales, monitoring your transactions to make sure that you're kind of hitting the right thresholds. Next slide, please. So registrations are kind of the next step that we look at once you kind of hit that nexus, or if you're establishing a new location, because a lot of times you may have an existing registration already, and you have to analyze essentially whether or not you need additional registration, a brand new one, or whether or not you can kind of add on to your existing registration that you already have. When you're going through there, if you're brand new to a state, there's a lot of considerations. You know, it should seem really simple for a lot of these registrations to, you know, go through and allow the states to say, hey, I'm trying to give you some money. Unfortunately, it doesn't always work out that way, and some of these registrations can kind of create some issues and some traps really for the unwary of, you know, maybe making taxpayers register for a tax that they're not even subject to. So, you know, the really important thing to look into is just carefully considering when you're going through there, not fill out any irrelevant portions of that registration, and you know, really kind of make sure that you have the business start date correct. Or one of the important things too is registering as of a date in the future. So a lot of states will allow you, if you know that you're having a new concept open up in say 3 or 4 months, you can create a registration and have an effective date of the registration. There's certainly some red tape that goes through getting registered and getting everything set up, and it's not as simple as, you know, going online, filing it, and having a brand new sales tax account. So, you know, if you know you're going to be doing something, it's certainly a good idea to maybe do it as early as possible in the process, so that when you are go live, you don't have to deal with any hiccups from registration and you can start filing. If you do register and your location is not open, but that registration is active, the state is going to be looking for a return from day one. From the day that you establish that business start date, they're going to look for a return. So a lot of times, and a lot of traps that people say is, oh, I'm just not going to file a return because our restaurant isn't open or our store isn't open. And that just can be a trap, even though it maybe is your return. Once you establish that registration, go ahead and start filing. And like I said, I mentioned again, you know, just making sure you're aware of all the questions, other tax types to, you know, make sure you're fully registering for all the state taxes that you can, and the ones that you really shouldn't be, making sure to kind of go through there. So, you know, we certainly helped a lot of clients to get in some of those situations, and it's easier to not register for a tax than to get unregistered. Getting unregistered, a lot of times you have to provide a lot of information to say, oh wait, I made a mistake. Seems like it should be something simple, but, you know, states make you ask a lot of those questions or answer a lot of those questions once you've kind of completed those registrations, even if they were in error. Next slide, please. A lot of the new registrations, this slide here really kind of focuses on a lot of new registrations and some of the information that you really need to complete a registration. While a majority of a lot of these states are allowing you to do this stuff online, there are still some paper states. And the one issue too that pops up a lot of times, it's If you complete an online registration, a lot of times it's a one and done deal. So it's, you can't save your progress. Some of these are 8, 9, 10 page registrations that are asking for a lot of information. So this slide here really focuses on some of maybe the nuanced items that you should have ready to go when you're completing that registration to make sure that you can kind of get it done as soon as swiftly as possible. Things like, like the Secretary of State requirements, some states actually will require you to register with the Secretary of State before you actually get a tax registration or a tax account number. You may also have to pull a certificate of good standing from your registration state. And so those things are kind of, items that you don't necessarily think about. Member, officer, personal information is always another thing too, of social security numbers of maybe a passive partner. Another question we get all the time is, do I really have to provide that information? And that answer is yes. And usually you can't really move on to the next section of a registration until you provide that information. And the reasoning behind that is really kind of that last bullet point of the kind of the responsible party ramification. So that really goes to sales tax is a trust tax. So you're collecting it on someone else's behalf and remitting it to the state. If you don't remit that to the state, it's crime. And there has to be some type of responsible party pieces there. And so that's why they ask for a lot of member, officer, personal information, so that if there is some type of criminal matter that happens in that situation, they can track down who those responsible parties are and find out, all right, who did what, when did they do it, and kind of do it that way. So of course the answer is whatever tax you collect, you remit. That's simple. And if there's any errors, you can kind of figure it out on the back end. And then the one last thing I want to hit on too, I kind of jumped over, is that hard copy mailing with account numbers or access codes. This is one that can really be a hang up when you establish a new registration. Is you will go through, you will actually set up your account, everything will be done and complete. And as far as the state is concerned, you now have a new sales tax account. The problem becomes is they're also going to mail you some type of account number or activation code that you then have to go in and activate your account. So in the meantime, what's happening is the state is looking for a return, but you haven't gotten that access code or that account activation number that's getting put in the mail. So it's really important to stay on top to say, I've completed this registration. The next thing we need to do is find this access code to activate your account and go forward and stay on top of it. So again, you don't miss any filings. And you really don't start driving any past due returns solely because something got crossed in the mail. Doesn't happen in a whole lot of states, but there are some that do it that way. I don't know why, but that's kind of how they've been handling that piece there. So just kind of more things to think of on that situation. Next slide, please. Yep. So one item, of this whole Wayfair legislation and kind of economic nexus piece that has affected restaurants, and perhaps at the beginning unintendedly, was this concept of marketplace facilitators. So in a nutshell, what a marketplace facilitator is essentially a third party who is someone's selling through a third party, and they are basically acting as if they were the seller for that item. So the typical one, it was going after those Amazons and eBays of the world, where you can place something on Amazon, Amazon's going to sell it, they're going to fulfill everything, they're going to look like the seller, even though there's a third party that's doing it. And so these states that enacted these marketplace facilitator laws said, no Amazon, no eBay, you're actually the seller of it. You have the duty to collect and remit sales tax. So at the outset, it was pretty simple what they were going after. The Amazons and the eBays kind of fought back for a little bit, like, you know what? Probably makes a little more sense. We don't have that liability there, and it kind of makes everything easier, and it kind of worked out. What happened was, as you start looking at some of these definitions of marketplace facilitators, is the non-traditional ones. And the restaurant industry is firmly in the crosshairs, especially with a lot of the third-party delivery services. So Uber Eats, Grubhub, DoorDash, all of those items, step back and look at it like, wait a second. You place the order through the Uber Eats website, you're getting it from XYZ restaurant, and they are delivering it. How is this not a marketplace facilitator? So what happens in this situation is these delivery services really had to scramble to figure out, all right, what do we need to do? What are responsibilities, especially in the food service industry, where the taxability of these items have a lot to do with, are you eating it for here to go? Is it a delivery? Is there alcohol sales? Are there soda sales? And so it became a little bit of an issue there. And so the important thing to know in this situation is that all of these third-party delivery services, if they're operating in the state and meet the thresholds, are considered marketplace facilitators. And with that comes that sales and use tax collection responsibility. So the biggest thing here, and I know a lot of the ones that I have listed on there are already doing this, but it's making sure that you are communicating with them to have them understand how are they capturing these dollars, how are you making sure that you're not remitting those dollars even though they may be capturing it, and just understand that, you know, that is their piece, but you also need to account for it to make sure that taxes didn't get double remitted or that it's getting remitted in general. And, you know, determining what states have these opt-out clauses. So some states do have an opt-out clause where you can actually go forward and say, hey, you know what, we're handling this, we can do this. You have an agreement with the third-party delivery service, and you can actually opt out of being a marketplace facilitator to even have any kind of gap between those pieces there. So, you know, the takeaway from there from these third-party delivery services is to have the conversations with them. It's nothing new with them. And so just to understand who's got the right roles and responsibilities and how is that tax going to get collected and remitted from that standpoint. The last piece of this one too is, and this is still a little bit uncertain, but I think a lot of the third-party delivery services are taking the position that local food and beverage taxes do not apply to marketplace facilitator laws. So there still could be some outstanding potential liability for restaurants in that they still may have to collect and remit the food and beverage taxes beyond the sales tax. So the marketplace facilitator laws are really written with sales tax in mind and doesn't quite contemplate the food and bev taxes. So it's just something to kind of take into account as you're going through there to say, hey, if they're not collecting it, that still can be your responsibility to collect on the food and bev taxes. Next slide, please, Carrie. So, you know, the kind of the next logical step really at this point is to develop oh, Matt, is this your part? Okay. So really develop a multi-state compliance process. And, you know, as you grow and as you scale, you know, understanding when is it time to start using compliance software versus maybe a fully manual method that you're doing. When is it time to maybe partner with an outsourced vendor to say, hey, maybe it's time to take away, you know, we've got 50 restaurants now, you know, we can't have one person do this anymore. When is it time to kind of do some of these things and have this planned discussion? We certainly help a lot of our clients in this space kind of come up with that determination to say, hey, you know what, maybe it is good to keep this in-house, or maybe it's important now to say, you know what, this is something we don't really need to handle anymore. Let's kind of figure out how we can source that. And, you know, a lot of it's going to be kind of managing your size and your growth and the importance of the filing calendars and things of that nature. And, you know, you got to think of the different types of taxes that you're going to be having. So I mentioned before, there's a lot of local food and bev taxes, local gross receipts taxes are starting to become popular. These are all kind of returns that you need to take into account when you are actually starting to file these returns and go from there. Next slide, please, Kyrie. You know, some more consideration to think of is, you know, at this point of as you grow, as you scale, what does that increased cost of compliance look like? What does your current system, what are the capabilities of that system, and can they handle these food service specific taxes? You know, as you kind of grow, you know, not a great example, but you go cross border into Pennsylvania or Tennessee or Indiana, you have some of these other local level type of taxes and food and bev taxes that maybe your accounting system can't quite handle. And so you really do kind of got to figure out what our systems can do and have that discussion and figure out what you can do prior to kind of moving forward that way. Because, you know, the last thing you want to do is be reactionary and say, oh, you know what, our systems can't handle this growth anymore. We need something else. So now it could halt the growth because now a POS system isn't working properly. And so, you know, it all comes down to headcount and understanding what your tax department can and can't do. You know, tax departments really aren't for large companies anymore, especially with this increased filing footprint. So, you know, last piece on this one too is if you do kind of decide to go that outsourced route, it doesn't mean that your responsibility is over as a taxpayer, you still have to do some communication with your suppliers and vendors to make sure that you're getting the timing approvals correct. Some payments need to be actually in before the returns are due, and just kind of understanding whose roles and responsibilities are which on each of these situations. So, it's just, you got to have that right relationship to understand that if you do outsource, kind of stay in that constant contact so that nothing falls through the cracks in that situation. And with that, I think next piece is for Matt for a couple slides, and then I will be back in a few moments.
Thanks, Jeff. So what we thought we would do is talk a little bit about some of the sales and use tax, opportunities and risks that we're seeing on audit. We're going to focus on Ohio, but it has some implications across the country depending on what state you're in and how they view certain things. So one of the big items we talk about a lot with our clients is new construction, build outs, tenant improvements. And one of the issues we see a lot in Ohio is related to real property construction. And the issue is this. So most real property construction, 4 walls and a roof, is dealt like with any construction in Ohio, meaning that the contractor pays tax on the materials and then they don't charge tax to their customers. So that's general real property construction sales and use tax. A lot of states are like that. There's some nuances. Construction is difficult, but there's nuances across the country. The issue comes with the contracts to install tangible property and business fixtures. And what that means is that you have to treat things differently. And the key is, if you're installing tangible personal property that primarily benefits the business conducted on the premises, then that item doesn't turn into real property. It retains its status as tangible personal property. And so the issue is, well, how does that treat it any differently? Well, installation of a business fixture, the contractor is not going to pay sales tax when they buy materials. They're going to purchase them for resale. Then when they invoice you, the restaurant owner, they're going to charge you sales tax on not only the materials, but then the labor, overhead, and all costs to install that piece of tangible personal property. So, what it really is an increased cost based on that labor dollars that are in overhead that's included in that price to you. But the issue is, from a restaurant perspective, you can see is there's lots of things that are really specific to the business that really don't relate to the building. So what we'll kind of do, show you a little bit of some of the examples that we see in the restaurant business. And just know that a lot of states are different on how they treat business fixtures versus real property. Some are a little more pronounced, like Ohio. Then you get into other states like New York, New Jersey, PA, West Virginia, that have very difficult, I'd say, construction rules for sales and use tax. So next slide, please. So if we look just at Ohio at some of the things, what we did was list out all the things that we view as being problematic in Ohio, as far as things that you would think might be considered real property that are not. They're actually business fixtures. So exhaust hoods is easy. Grease traps is the other one. It's out in the parking lot generally. It comes out, somebody gets cleans it. And what that is that grease trap is considered a business fixture because it's collecting grease from the fryers and other things that work in the kitchen. But ultimately, having somebody up clean that, what they're doing is a taxable service because they're repairing taxable tangible personal property. Walk-in coolers and freezers, there may be an exemption that applies for preservation of food, but a lot of times those are considered business fixtures. Signage, that's a big one. So the signs on the road, the signs on the building, any type of signage that has the company's name on it, that's a business fixture. So that installation of the business fixture is going to be taxable. Drive-through windows, menu boards, those are all taxable business fixtures. Security cameras that are internal. So anything that's looking for theft internally, that's going to be a taxable business fixture. Security cameras that are on the outside of the building that are protecting the real estate, those are still considered real estate. We talk about specialty indoor and outdoor lighting. So if there's lighting that actually is shining just on the sign, on signage, that's a business fixture. Just know that general parking lot lighting is real property. Window treatments are always going to be business fixtures. And then just keep in mind that what we see on the expense side, so we talked a lot about business fixtures, those a lot of the times are capital assets or fixed assets that you're purchasing when you do the building construction. But ultimately, after that stuff is installed, it still retains the status as tangible personal property. So any ongoing repairs and maintenance that happen to business fixtures, those are also going to be taxable. So that's on the new building, new construction. If you could switch slides. We'll talk about then some of the Ohio exemptions that are available. So for restaurants, now we get to the expense side of the house. And generally, Ohio does provide a sales tax exemption to licensed food operators if you're preparing food for human consumption, preserving food, and then cleaning tangible personal property. So the preparation of food is going to be your ovens, your grills, your rotisseries, things like that. Preservation is going to be refrigerators and freezers, not for beer coolers, but for if you're holding food and not display cases. And then cleaning going to be your dishwasher, other things. So in other available exemptions to the restaurants include manufacturing, packaging, and then resale. Resale comes into play with a lot of times with plates, silverware, tables, chairs, things that because you're charging sales tax to your customers on dine-in, basically you can resell the chairs and tables as part of the price. So you get a resale exemption. We focused on this slide really Ohio, but the reality is a lot of states have similar types of exemptions, indirect manufacturing, packaging, resale, a lot of utilizing the same type of exemptions. Ohio has the restaurant equipment and supplies listing. If you don't have that, you should be utilizing that because it goes through pretty much everything that you would buy in the kitchen and inside the restaurant, and whether it's taxable or not, how the department treats that. So next slide, please. And with that, I'm going to switch it back to Jeff, and he can talk about managing property taxes.
Alrighty. Yep. So for the last 10 minutes here or so, we'll kind of give a high-level overview, and really I'm going to try to hit on some of the high points of this situation and how it can pertain to restaurants. One of the interesting things about property tax, is a lot of times the thing that taxpayers think is that there's not a whole lot that they can do to actually manage their property taxes outside of maybe the appeal process if you've gone through there. But there really is, when you start realizing that there's some things you can take advantage of as far as managing inventory levels in states that may tax inventory on the personal property side, and proper classification as well too. But it really all kind of starts off with using a system to properly track everything in one location so that where everything is, when everything's due, and you can understand that if there are appeal deadlines, you've kind of got this all in the same place. This should really list out things like what the state and the county value the property at, what your return said it valued at, kind of determine out whether or not that they're both in line with each other. And if not, kind of looking into, is it an error on the side of the county? Did something happen where maybe you missed something on return? But it all kind of starts in this tracking system to make sure that kind of everything's in line, and that you can kind of compare these property tax balances and property values in a year-over-year basis. It should include things like billing payment deadlines, appeal deadlines, and so on and so forth. This whole piece really should kind of involve the entire multiple area of finance, because you can really kind of use this not only to ensure that you're paying the proper amount of tax, but for budgeting and forecasting purposes as well too, and really kind of take advantage of nailing down what your property tax is going to be. A lot of times it's not really that big of a mystery once you understand what that process is, and it can really kind of help you take advantage of any discounts and things of that nature by, again, tracking everything in one kind of place. And that really is going to be that first line of defense you have in resolving minor discrepancies without the appeal process. Be surprised or maybe not surprised that counties mess up a lot when they send bills, where they may send them to the wrong address, have the wrong values, or one of the more common ones you see is that if you close a restaurant and you file a final return, that they may just ignore that return and send you a bill until you call them and say, hey, we filed this last return as a $0 return. Here's all of our information. That can be a really quick way to get property tax bill completely removed. So again, kind of creating that process and knowing when all these due dates and when all the timing should come into fruition. Can you jump into the next slide, Kyrie, please? So when we manage the valuation, each county, each state has a local reappraisal process for real estate. So it's some type of cycle that allows you to appeal if you disagree with the value. And a lot of times that'll come with some type of county notice of value, which could potentially trigger an appeal clock. So it really is important to understand when these notices of values are, and kind of starting doing the legwork ahead of the appeal deadline, so that you're not scrambling at the last minute to kind of get something done and complete. And it really kind of allows you to participate in that process. So you get that notice of value. A lot of times there'll be something on top that says this isn't a bill. This is just your notice of value. But what it's not saying, or what it may not say sometimes, is that this could say, hey, this is our appeal right to make sure that something is correct or not correct at this time. You can fix these administrative issues, and it's going to save you a lot of time and money, because a lot of times the further down the road you go, the more likely it is to become a traditional legal proceeding as opposed to an administrative proceeding, which once you start getting some of the lawyers and stuff involved, may not be worth the tax dollars that you're trying to fight. The classification of property is important too, especially in states that have a dual property tax system, a personal and real property tax system. And this kind of goes back to what Matt was talking about a little bit with the business fixtures. Excuse me. With the business fixtures and how those relate to real estate. A lot of times, if you are able to classify something like a walk-in cooler or like a drive-in window or a menu board as personal property, you can take into account that accelerated depreciation and really kind of get that value lowered, as opposed to if it's getting considered part of the real estate, that value may hold for a while. So it really is important to understand in the states that have that dual system is what is most advantageous from a classification standpoint, and is there backup from the state department's guidance and stuff like that to support that position. To get something maybe over personal property, we can kind of continually depreciate that property. And really understanding that if you do take that classification, if you do take that position, you have to make sure that that property is being utilized as classified. Otherwise, what can happen is it can trigger clawback provisions from prior years, or for all those years that possibly that property wasn't being used for the purpose that you said it was. A lot of things with property tax, especially on a personal side, it's an honor system thing until you get audited. And so that's the one where, they're going to take it as good until the audit comes through, and that's where you can have your problems in that one. So it really is important to have that right classification, but take advantage of the benefits that are afforded to you when you certainly can. Next slide, please. Again, in the last couple of minutes here, if you are unhappy with the value, and because these values are ultimately determined by a taxing jurisdiction, there is an appeal process that is available across all property tax types in all states. In order to be successful, so you can't just be upset you're paying a lot of tax, a lot of taxpayers are, you have to provide support of value. And what we mean by that is some type of sale documentation on the real property side, an appraisal. So even personal property can get appraised as a going concern, comparable sales, or some type of proof. Basically, the biggest thing that you need to take a look at in these situations is proof that your value is too high and that it can sustain an appeal. Some considerations that you can think of as you go through this process is the possibility of a tax increase. So you could actually be undervalued, and in a lot of situations, the school districts can get involved and they can actually challenge for an upward assessment. It does happen that way too. So, just being angered by paying too much tax isn't necessarily the right way to go. Current year of the appraisal cycle. So a lot of times if you're near the end of a reappraisal cycle, the county can just kind of jack that value back up if it's just going to be hitting that new cycle again. So just understanding that, the earlier you are in an appraisal cycle, the more future tax savings you have, because a lot of times after an appeal is complete, these counties, these states can't adjust the value for a certain period of time. Cost benefit analysis. So a lot of these appeals do take some time, or do take some money through the cost of appraisals, attorney fees, things of that nature, and also too some loan covenants. So a lot of times certain loans have to carry a certain value by what's securing it. So, you know, the county value falls below that, you could run into some issues as far as getting some loans called. And then, you know, the last piece of that one is, you know, many of these appeal processes are legal proceedings from the outset. So it's important to understand which ones those are, because that could get an appeal thrown out right away if the right channels aren't being followed and the wrong parties are filing the appeals. So just kind of food for thought on that situation as far as appeals go. Next slide, please. You know, some common property tax traps and pitfalls, some entity sales. So a lot of times what taxpayers were doing and what people were doing is they were actually creating a new entity and then selling interest in the entities. And so the counties were starting to get smart in determining that, hey, this property just got sold. We're going to go find another means to determine the value. So maybe a mortgage or a loan document, some type of UCC document, and it was really being done to kind of conceal, you know, the value of the real estate that was being transferred. So this is kind of more of a real property concept, where basically, you know, it was being done just to conceal the recorded value that's a public document request. You know, there's variable appeal deadlines. So again, that kind of goes back to the piece of, hey, what's happening here is as far as your filing calendars and your appeal calendars. Expiring abatements. So if you do happen to have an abatement at that time, you know, it really is important to understand when that abatement ends so that the value doesn't get rolled onto the property tax rolls at a historical cost. You know, maybe what that cost was 10 years ago when you got that abatement, no longer going to be there. So you may have to kind of preemptively appeal that value so that when that abatement does roll off, you kind of have that piece there. And again, you know, understanding the appeal process and properly filing those appeals. There's some of the pitfalls. And next slide, please, Kyrie. A few more things here on the closing piece. You know, new construction, you're always going to kind of run into some valuation issues. So basically, most property taxes, the lien dates are an as of date. So if you have a new construction that you're building as of this January 1st lien date, it should be valued as of that date. And sometimes states will take a shortcut and kind of pull permit totals, and you know, there could be an opportunity there for some savings if you can prove that, hey, it never hit that permit value, or we were only percentage completion. So some things to think about there. And then again, I kind of hit on this already, just pay attention to abatement agreements and how this works from a property tax standpoint, and making sure you're kind of maximizing those credits. So next slide. And with that, I wanted to get to the third activity code word. That was my one responsibility from Kyrie today, is to make sure we got to all of them, and I think we did. So your third activity code word is restaurant. And with that, we've reached the end. Don't know if we have for questions that were right at the time. Kaz or Matt, I don't know if you had anything else you needed to add.
No, I think we're right at the end here, and no questions came in, so I think we got it timed here perfectly. So, Kyrie, next slide, please, if you don't mind. Just a couple resources here we wanted to hit on. All this is on our website. A lot of thought leadership from our restaurant practice, but some of these topics we went over today. So please feel free to check those out. And then contact information for myself, Matt, Jeff, and then one of our other colleagues, Judd Ballard, who's part of the restaurant group, who wasn't part of the presentation today, but is definitely active in the space and helping us out. So feel free to reach out to any of us on any questions you might have from today's presentation. We'd be happy to get back with you and help you out. So with that, thank you everybody for attending. And I think, Kyrie, we're good to go at this point. Let me know otherwise.
Yep, we're good. Thanks everyone for
Okay.
attending.
Thank you, everybody.